A huge chunk of U.S. debt is held by foreign investors, mainly governments and central banks. They hold about $9 trillion, or 25% of the total. This chart shows which countries hold U.S. debt. Japan leads with $1.1 trillion, followed by China with $761 billion, and the United Kingdom with $740 billion. But here's where things get dicey. There's potential evidence that demand from some foreign governments is weakening, and the Trump administration's policies could make it worse. Let's break it down. Why would foreign governments keep buying U.S. bonds? First, U.S. Treasuries remain a safe haven, especially in times of global uncertainty. If other economies falter, investors flock to U.S. debt for stability. Second, countries like Japan and China hold treasuries to keep their currencies competitive. Buying dollar-denominated bonds helps prevent their own currencies from appreciating too much, which could hurt their exports. Third, with $8.5 trillion in U.S. debt held abroad, these countries have a vested interest in maintaining the dollar's value and the U.S.'s creditworthiness. A stable U.S. economy benefits their own financial systems. These forces support continuing international demand for U.S. treasuries. But why might they sell or stop buying? This is where Dalio's warning gains traction. The Trump administration's aggressive trade policies, particularly tariffs, are shaking things up. They've already spiked average U.S. tariff rates to over 22%, the highest since 1909, and they're sparking trade wars. These tensions are prompting foreign governments to rethink their reliance on U.S. debt. China, for instance, has been quietly selling U.S. treasuries for years, reducing its holdings to $761 billion by early 2025. This is partly to diversify reserves into gold and other currencies, but also due to ongoing trade disputes and geopolitical tensions. So, is there still demand for U.S. bonds, or are we nearing a debt death spiral? For now, demand hasn't collapsed. Domestic investors, like private funds, are stepping in as foreign buying slows. The Federal Reserve could also buy treasuries to stabilize markets, known as quantitative easing, though this risks inflating the money supply and devaluing the dollar.